They really had a pretty sharp sell-off at the end of the day yesterday, and a weak rally. And the bears are hoping that this is a spike down and that will begin a channel, a series of lower highs and lows inside a channel. The market right now is hesitating at the June low. This is the daily chart. This is the cash index. The bulls are hoping for a double bottom. And yesterday would be a buy signal bar, but it's 4 consecutive bear bars, and it was a bear doji. And therefore, it's not a very good buy signal bar. If we go above this high, there probably will be sellers above. And therefore, the bulls need the market to stop going down and start to go sideways for 2 or 3 days and form a micro double bottom with 1 or 2 bull bars. That would make more bulls willing to buy. They're hoping for a rally above this high and then the market continuing up. This is the most important high. It's the top of a very strong buy climax. The bulls would like to get above that and go up to the high of the year. Tom Lee is always saying that on Fast Money, but at this point I think it's unlikely. What I think is interesting is the market has made several attempts to bottom. We had a truncated wedge and an expanding triangle, and every bottom has failed. And then we had another expanding triangle here. I don't have it drawn in. And now we have a bigger expanding triangle here. So we're getting consecutive bottom patterns and with reasonably good patterns. And that usually does not happen in a trend that's going to go a lot lower. What I'm wondering is, let me put up the weekly chart. Here's the weekly chart. The bulls are trying to keep the market from getting below the pre-pandemic high, the green line. And we're so close to it, I think there's a 50-50 chance we'll get below it. I think we'll probably go lower than we are now, whether or not we bounce. And if we get below that pre-pandemic high, then the market will probably test the next support levels. And there are several. And one important one is this one right here, this gray line. The market gapped up in April last year, and it accelerated up. We got a breakout test, this low, this high, or that high. And it's really the first time at a big round number that the market did not pause. And therefore, it was important. I said in here that I thought we'd come down this year and close that gap, which we did. And it looks like we may go down for a measured move. Whenever you have an important price, the all-time high is important. And then this gap is unusual. It's the first time we hit a big round number in this rally and did not pause. So that's unusual. That makes it important. Then we spent 4 months oscillating around it. That makes it important. When you have 2 important prices, they often create a third important price, a measured move, which is below 3,200 and below the pre-pandemic high. So we may get down there. A lot of traders like to buy a percentage pullback, 10% pullback, 20% pullback, 30% pullback. We're more than 20% down now. A 30% pullback is here, a 40% pullback is here. So traders will probably be more willing to buy here and here than they are currently. So I'm hoping, I'm sitting on some cash, a lot of cash actually, and I'm hoping to start scaling in around 30% or this measured move down or somewhere in here. And the reason I have 35% highlighted here is because of this. The pandemic crash was 35%, and the market may look for some symmetry, and therefore 35% is another important price. So I'd really like to buy somewhere in this area. The chance of falling all the way below the pre-pandemic low right now is probably, I don't know, 20%. I want to say one other thing about that. I'm missing a price on that chart. Look on my other computer, see if I can find it. Yep. Okay, I'll put it on now. The pandemic low is 55% down. And although 55% corrections are rare, they do happen. Here's the monthly chart. I don't have it drawn in, but this was about a 55% correction here. And so they definitely happen. And this was, I don't know, 40 or 50% here. And then in the 1970s, we had a couple of corrections, around 40%. Here is like 35%, 50% here. So they happen, but they happen rarely. So in 1970, and then 2009, so 20 years, 30 years, 20 years here, 30 years here. And we've been a long time without one, about 13 or 14 years since then. But I don't think we're going to reach that. And I had this red line drawn in, and I talked about that several times, that it's a bull trend line. And very often, big sell-offs end at major monthly chart bull trend lines. This 2009 collapse ended at a bull trend line. And the 1987 crash ended at a bull trend line. So whenever you have a really serious sell-off, you have to be looking at the monthly chart for bull trend lines. And then if the market gets there, you look for a reversal up from there. And right now, this is, I don't know, 2,500, 2,600. I don't know. I don't have the scale on. But if we get there next year, it might be 2,800 or 2,900, which is up in the neighborhood of 40% down. All right, so big down, big up, a higher low, major trend reversal. Not great to buy above the bear bar, but if bar 2 closes near its high and above 1, that will attract buyers. Obvious problem is the risk, right? You're risking 25 points, 30 points buying above 2. And you say, well, it's a good buy. Well, it's a good buy, but if it's too much risk for your account, you have to trade small. And I always talk about having 2 position sizes. One, your regular size, and then in situations like this where you think you want to buy, but the risk is too great, have a second size and have it be a lot smaller than the first size. So if you're buying above 2, I would buy maybe a 20% position size. So if you normally trade 1 E-mini, you'd buy with 2 micro E-minis. Good candidate for the low of the day. But as I said, big risk. The bears were hoping that bar 1 was the beginning of a bear channel, so spike pullback channel. Instead, it was a bear trap, and we're reversing up. So this looks pretty good for the bulls. I would say at this point, more than 30% chance we've seen the low of the day. We also went below the Globex low. And what else do you notice about the Globex range? It's not especially big. And when you have a Globex range that is not very big, there's an increased chance that the market will break out of both the top and bottom. We broke out of the bottom, and the bulls now will try to get above the top of the Globex range. Now, how bullish is this going to be? The more it closes on its high, the higher the probability is that we're going to go up. Anybody buying, their stop is below 1, so they're risking 30 points or so. So, if you're buying, you have to trade really, really small. A lot of traders don't want to risk that much, and they don't want to trade small. And as an alternative, what they try to do is they try to buy a pullback. And the market, when it has a big move like that, often will have a 50% pullback. And right now, 50% is like this. But if this goes up a little bit further, like up to here, before it pulls back, then 50% will be here, around the breakout point above 1. So some traders will buy small and then scale in. Scale in if it goes against them, or add to it if it keeps going up. And other traders will prefer to buy the first pullback. Can you sell? Betting it's a bull trap, a second leg bull trap. So we have a wedge here for the first leg, and then now we're getting a bull breakout on the second leg. I would not. We're at major support on the daily chart, testing the September low. We have a bad sell signal bar on the weekly chart, a bull bar last week. So both of those things reduce the chances of the market collapsing from here. Today is an FOMC minutes day. So at 11 o'clock, the FOMC releases its minutes from the last meeting. And I mention that because you should exit all day trading positions at some point ahead of the announcement. On the announcement, be ready for anything. The market could rally strongly, it could sell off strongly, it could go one way and then reverse, and least likely it will stay in a trading range. So right now, can you buy at the market here? Yeah, I think you can be long stop below 1. I think it's better to look to buy above the bull bar, like above 2, or wait for a pullback. You know, if we're lucky, we'll get a 50% pullback and then a good buy signal bar. I want to talk a little bit more about that FOMC thing. And then these other alternatives, each is about 15% of the time. So 15% of the time, you get a small pullback bear trend, 15% of the time, small pullback bull trend. 15% of the time, you get a bull trend that reverses. 15% of the time, you get a bear trend that reverses. And 15% of the time, you get lots and lots of reversals. And only about 10% of the time, you get virtually no reaction at all. It looks like an ordinary day. Also, you should wait for at least 10 minutes after the report before looking to trade. Because on the report, 75% of the time, there's a move in both directions. So up and down. And you don't know which will lead to the swing. And here we were down. It's a pretty big move down compared to these bars. It's a big move. It looks small compared to this bar. So we went down. Here we went up and all the way back down to here. At one point, this was a big bear bar. Here we went down and up. Here we went up and down and up again. So it's usually better to wait for at least the close of the second bar before looking to trade. So here we have a bull trap, a bear trap, and then a good-looking bull bar, a reasonable buy. And because reversals are common, it's better not to hold and hope that you're going to get a trend. Remember, only 15% of the time will the bull trend last all day. If it is a bull trend, you can just buy above bull bars. If you want, you can get out below a bear bar closing near its low, and then wait for a bull bar closing above its midpoint or near its high and buy again. Right now, we're always in long. That's a major bull surprise from the low of 1 to the high of 2. Okay, that's about almost 30 points, and it's coming at a good location near yesterday's low, and it's a higher low major trend reversal. Can you sell below 3, betting that it's a bull trap after a bear trap, and that it's a second leg bull trap? I would not. But if 3 closes on or near its low, it would be reasonable to get up below 3. And you can then look at buy again if 4 is a bull bar, or you can buy again at a new high, breakout above 2. Monthly chart. It's still more likely that this is a pullback in this bull trend. It may retrace 50%, which is this pink line here, just a little bit below where we are. It probably is going to get down there. You know, could get there in the next week or so. We could bounce and then get down there, but we're probably going to get below a 50% retracement of this 2-year rally. And then one other point, this red line here is the low of last year. And in January, we went above last year's high, and then we went below last year's low in the cash index here, but on the E-mini over here. So this year is an outside down year on the yearly chart. And since it's coming in a strong bull trend, I think this year will close above last year's low. And this big, thick blue line is last year's low. So I think December 31st is going to close above that blue line. Yesterday, I popped in for a few minutes to make a point. E-mini is a futures contract. So it's telling us what the institutions think the futures will be when this contract expires in December. And right now it says the institutions think it's going to be at 3610. The cash index right now is at 3600, 3599. So the institutions believe the stock market is going to be higher in December when this contract expires. I'll put up the March contract. Okay, This is the March contract, and it's 36.76. Remember, December is at 36.10, so March is 60 points higher than December. So the institutions think that the market is going to be much higher in March than it is right now. Okay, so bears are hoping a second leg bull trap, but there will be buyers at a 50% retracement, and there'll be buyers below the low of the prior bar, below the low of 3. I'm putting this in because very often the market will dip one tick below 50%. So again, I think it's okay to be long if 4 closes below its midpoint, especially if it closes near its low. Reasonable to exit, but you don't have to. Remember, if you're buying a very small position, and you can keep your stop below 1. And what about shorting? It's a possible high of the day. On the open, you tend to get reversals. Any strong move up or down, you should always assume 50% of the time it will reverse. So, but we've already had a pretty strong reversal. So I think, I'd like to see it break below 1 or go sideways and form a micro double top before selling below 4. Because right now it's more likely there'll be buyers around 50% right there. What happens if you do short below 4? Well, you're taking a relatively low probability bet. It's more likely that we're going to get a second leg up after seeing 2, 3 reverse up from 1. So it's a low probability bet. Low probability bets are fine if you hold for swings. If you're taking a low probability bet, you need really good risk reward. And since the risk is relatively big, you need a really big reward. So you have to bet that we're going to repeat this. And chances are we're not. Bears trying hard to get the bar to close on or near its low, hoping that it's a bull trap and that the bulls will give up and that the bulls exiting will create enough momentum down to attract sellers and then we'll break to a new low. But more likely, there'll be buyers around 50% and buyers above the low of 1. Will I wait for it to break below 1 before shorting? I probably will if it goes straight down, but if it bounces here and forms a micro double top and reverses down the second time, I would short on the second reversal down. So bulls do not want it to go below 4. So what are they going to do? They're going to buy the market. They're going to buy the close of 4. Some will get out below 4. Others will buy more, 5 points lower, 10 points lower. And the bears, it's a low one. Well, it's a low 2 sell, 2 legs up, a wedge, and then pull back, and then a second leg trap. So bears will sell. They're hoping the bulls will give up. Okay, we're right around 50%. Are the bulls going to buy? Okay. Are we going to get a reversal up from around 50%? A lot of times it'll go 1 tick below, which allows the limit order bulls to buy exactly at 50%. Buy the close bulls, buy the low bulls, trying to prevent it from breaking back below the moving average, and definitely trying to prevent it from falling below the low of the day. And the bears, they know the odds are against them, at least over the next couple of bars, but they're trying to make the bulls give up. The bulls who did not buy above 1 or 2 or 3, they're hoping 5 is a good bull bar, and then they'll buy with a stop above 5. If you buy for any reason, you still need a stop below 1. You're not going to let the stop get hit. You'll probably get out before then, but that is where you have to put your initial stop. What happens if 5 has a big tail on top, a small bull body and a big tail on top? Then you have to put your stop below 1 because we might get a second or third leg down, maybe a high 2 or a wedge. What happens if 5 closes on its high? If 5 closes on its high and 6 goes above 5 and you buy above 5, then I put my stop below 5. Because if you get a very strong buy signal bar and you're betting on a trend, it should not drop back down below the bottom of a strong buy signal bar. Everybody wants more information. That's why we're doing this. More information means more bars. Not a lot of sellers below 4, but we did not quite reach 50%, so some of the bulls are hesitant, thinking that we probably have to fall a little bit lower. But if 5 closes on or near its high, you will get stop order bulls buying above 5. Can we still go above 5 and then pull back below 5? You have to be open to anything, but a lot of the bulls who buy above 5 will put a stop below 5, or a stop maybe 3 or 4 ticks below 50%, instead of all the way down below 1. And if it does go above 5 and then below 5, the bulls will look to buy a high 2 or a wedge. Remember, the bears want a micro double top, so they don't mind it going above 5 as long as it reverses down on 6 or 7. Then they'll have a micro double top. What about a 7 o'clock report? There's often a report or an announcement at 7 o'clock, and sometimes the market will react on it. I'm concerned that we did not quite reach 50%. So to buy above 5, I want 5 to close on its high. Best case for the bulls is, at this point, maybe a couple small legs down to below 50% and some bull bars, and especially one bull bar closing on or near its high. The bears will slow below 4. It's a really good looking bear bar, and it's a credible short. So I suspect we're going to fall at least 5 points below 4. So I think we're probably going to fall a little bit further. Whenever you do something that's reasonable and you manage it correctly, you're probably going to make money. In general, I say that 80% of the time, if you do a reasonable thing and you use a wide stop and you scale in, you can avoid a loss, and 60% of the time you'll make money. So for the bulls, it's the bull trend 2-3, a high 1, bar 5, but 2 bear bars. I would wait to buy. You can see we're right at 50%. We have that tail on the bottom of 5. So some of the bulls had limit orders to buy at 50% or a tick or 2 above 50%. But this is not doing what the bulls want. They did not want to see a big reversal of 4. They did not want to see 5 go below 4. They did not want to see 5 have a bear body closing below its midpoint. All of that reduces the chances that this is going to be a big bull trend day. And what about a big bear trend day? Right now, I would say 40% chance we've seen the low of the day, maybe 50% chance we've seen the low of the day. But if we get a 3rd bear bar or 4th bear bar, then the probability that 1 is the low of the day drops. So instead of 40%, it becomes 30%, 20%. It's still a high 1 above 5, but consecutive bear bars with one of them big, bar 4. So that will reduce the number of bulls buying above 5. Remember I said it was a buy above 1? Well, we're right there now. So the market is asking those traders, well, you thought it was a good price. Do you still think it's a good price? Are you going to buy again at the 1 high? And we don't know yet. Bar 6 often is a signal bar, a buy or sell signal bar. And I don't like bar 6 being a signal bar because there's often news at 7, and bar 7, 7 o'clock Pacific time. And bar 6 often makes a big move in the final second, changing its size, and it's hard to place an order exactly 1 tick above or 1 tick below because the bar market makes a big move in the final second or 2. Because of the 2 bear bars and bar 4 being big and closing near its low, my preference would be for this to go sideways for a few bars and maybe form a high 2. But just because that's what I want does not mean that's what I'll get. 6 may close on its high, and then traders have to quickly decide buy on a stop above 6. Now, bears sold below 5. Some bears did. And what will make them give up? If we get a bull bar closing above its midpoint, especially closing near its high, the bears will not, they'll exit above that bull bar. They will not wait for it to go above 4. They know the market is still always in long. It's still more likely to go up than down. So they'll be quick to get out. If the market is in a bull trend, which it is, it's an early bull trend, and you get a bull bar closing near its high, and you're short, it's usually better to exit because a lot of bulls will buy. Now, if a trader sold below 16 yesterday, you'd have to get out above, at a new high, above 18 or above a bull bar 21. If a trader sold below 23, I'd get out above a bull bar closing above its midpoint or near its high, above 24 or 25, because a lot of bulls will buy there. If a trader sold below 29, a bear bar and a wedge, I'd get out above 33, and I certainly would get out above 34, because some bulls will buy above 33, and a lot of bulls will buy above 34. Not a good buy signal bar, so can you sell it? And bet that we'll get at least a small second leg sideways to down. I would still rather look for a buy. So I'm not willing to sell yet, but it looks like we have to go more sideways to down. Can you buy above 6? A bull bar closing above its midpoint. Well, we're still always in long, but this is not nearly as bullish as the bulls want. So most traders better off flat. Long is okay, but managing the long is tricky. Do you exit below 5? Do you exit 3 or 4 ticks below 5? Theoretically, the stop is below 1. Remember, I said the bears will try to get a second reversal down, maybe 8. And if they do get a bear bar closing near its low, a lot of bulls will exit and bears will start to short. Nobody shorted below 4. You can see there were buyers below 4. But if we get a second reversal down, especially if 7 closes on or near its low and at the moving average or below the moving average, the bulls will give up. They will not wait for a stop below 1 to get hit. Now, decades ago, in a situation like this, I'd get ripped up inside. I want it to go up. I want, why aren't the bulls creating good bull bars? And I look at it and I say, the reason they're not doing it is they can't. The market is still undecided. Everybody wants things to be clear, but everyone wants this, things that are very, very clear, or this, things that are very clear, or this, things that are very clear. But that's only 5% of the bars on the chart. 95% of the bars on the chart, the probability of it going up or down is between 40 and 60%. So it's not clear. Remember, last week was a low 1 on the weekly chart in a bear trend, but it has a bull body, so it's a bad sell signal bar, and the bulls are trying to get back above last week's low. A more important price is this thick blue line. And it's really interesting to me. I have not heard anybody talk about it. Last year's low. But to me, it's such an obvious price, especially with this year going above last year's high and now below last year's low. I think this year will close above last year's low, even if we sell off sharply first. Bears trying to get a credible micro double top or low 2 or second entry sell, but they'll need another bar closing near its low for traders to sell below 7. Bull bar, so it's a low probability sell. It's a second sell for the second leg bull trap 3, but it's a bull bar, and I'd either be long or flat. I would not be short yet. it's interesting. As you know, as you've been listening to me for the past 4 years, I think Chairman Powell is a fool, an idiot, Fed Chairman Powell, and he's the worst Fed chair in my trading career. I started trading during Paul Volcker's tenure at the end of Carter and the beginning of Reagan, but I started day trading at the end of '87. And Powell was doing the right thing in 2018, and President Trump just kept ragging on him, calling him names, calling him stupid, and calling him lousy, and whatever. And the Fed chair is supposed to be independent, and President Trump was telling him, "You got to cut interest rates, make it below zero, like Germany." And at the time, I was saying that is absolutely stupid. The United States is never going to have negative interest rates. And I also said this about the bond market. Here's the bond market monthly chart. Okay. I said the bond market was putting in a major top. We had a head and shoulders top here, then we had one final run because late in 18, right here, Powell started printing money. He started quantitative easing, basically giving banks a ton of money. And this was the result. The bond market had a blow-off top, and you're never going to see this high again in your lifetime. We had a reversal down. We're still reversing down. Now we have a bigger head and shoulders top forming. We may bounce here for a few years, but ultimately we're going to be going down here at some point in the next 10 years. But let me go back to Powell. Powell did this. He caved, and instead of doing what was right, he did what was necessary to get President Trump to stop insulting him every day on television. And he did quantitative easing. And then all through here, this is the bond market again, I kept saying, no, he's making a mistake. He's not doing what's right for the country. He's doing what's right for him. He doesn't want to be called names all the time. This is the E-mini monthly chart. And here's 2018 when he did the quantitative easing. Here's the pandemic. And all through here, especially through here, late 2020, early 2021, I kept saying he's making a mistake. He's continuing to print money, and unemployment is really low. The economy earnings are good. It doesn't make any sense fundamentally, and technically we might be making a blow-off top. And one thing I kept saying is I don't understand why people on TV are not criticizing the guy. He's making a horrible mistake. He's the worst Fed chair we've had in 40 years. And now when you turn on TV, everybody says, oh, the Fed made a terrible mistake. They don't say Powell made a terrible mistake, but I think it's Powell. And it just makes me mad. To me, I'm an eye surgeon. I'm not an economist. But it didn't make sense to me. Why is he making money so freely available when we're not in a financial crisis? The stock market is soaring, unemployment is really low. All he's going to do is end up with inflation. And now, if you remember at the beginning of the year when they were talking about raising interest rates, I was saying we should not be raising 0.25% at a time. We should be raising 1% at a time because we have to raise rates a lot to undo the damage that Powell did and to stop inflation. And I got to say, to his credit, he's been raising it 0.75%, which is good. At some point, I think there's a risk to the stock market. Obviously, we're selling off because we're raising interest rates, but there's a risk that we could plunge very sharply. At some point, right now, the bulls look at the monthly chart and see a bull flag, a pullback, and a bull trend, and they expect the bull trend to resume. The bears are hoping we get down here. But at some point, if it doesn't resume, the bulls give up and you plunge. On the monthly chart, it'll give, one bar or so. But on the daily chart, we could get a pretty dramatic sell-off. Every now and then we get them. Here's one, 2020. I don't think we're going to get that much sustained selling. I think if we do collapse, I think it'll be much faster. Here's another example, 2018. but I think it may be more like this. Huge sell-off over a couple of days and then one more leg down, and then here a triangle sideways for a lot of bars and then resumption up. But I do think there's a risk that we're going to do that, where we get just a couple huge bear days like this here, 4 or 5 big bear days. Okay, this is 2015, and that's the end of it. The end of the selling. We had to go sideways for a lot of bars before we went up, but I think there's a risk that we're going to do this. Right now, all the bulls think that it's a pullback in a bull trend, but if they decide that we're going to go a lot lower, like down to the pandemic low, they'll give up. Think about it this way. I'll put up a weekly chart. Okay, let's say you're buying because you're not sure where the bottom is, but you're pretty confident the bottom is somewhere in this area, and then the market starts to collapse. What are you going to do? You're going to say, well, the bottom may be down here. I'm going to sell, and then look to buy a reversal up. And that's how you get these plunges. You get all the bulls hoping for a bottom in here, deciding that the sell-off is so strong, we're probably going to go a lot lower. So the bulls dump and they add to the selling, and you get a really quick move down. And then when it gets down to what they think is the next buy zone, they'll buy and the selling will stop. So a lot of times you'll get this kind of thing, a big plunge, and then it just stops going down. So I think we may get, we're trying to bottom we've tried to bottom many times over the past year, past 10 months, and failing. And if the bulls give up, we could get a quick move down to this area. Jamie Dimon, the CEO of JP Morgan, said the other day that he thinks the market could fall another 20%. That would be another 700 points, and that would get us down to those prices that I talked about, around 2,900, 2,800. So down in this area. So he's saying 20%. We may fall another 20%, which would be down in the next cluster of support, the next buy zone. And as I said, I'm hoping it'll happen because I want to buy stuff in my retirement accounts. All right, so we broke below 5. Not a good sell signal. Think about this. You got not a good sell signal bar 7. Not a good buy signal bar 5. Not a good buy signal bar 5, so they sold above it. Not a good sell signal bar 7. I suspect they are buying below it and below 5, the breakout point, and that we're going to try to form a high 2. We're more than a 50% pullback. So you'll get the 50% pullback bulls buying, and then you'll get the high 2 bulls buying above 9 if 9 is a bull bar. If 9 is not a bull bar, fewer traders will buy above 9. If 9 has only a small bull body, fewer traders will buy above 9. They'll wait to see if 10 has a bigger bull body closing on or near its high. But whenever you see a lot of reversals, down on 1, up on 2, down on 4, but not far, and then limit order traders making money, selling the high of 2, selling the high of 3, big bull bars, buying the low of 4, a big bear bar, selling above 5, a high 1, buying below on micro double top 7. All right, the limit order traders are making money, and you're getting a lot of reversals. It's a trading range. Traders tend to look to buy low, sell high, and take quick profits. The bars right now are big enough for traders to scalp for 10 points, but they're probably going to start to get smaller, and the limit order scalpers will switch to 5 points. Stop order bulls want 9 to be a bull bar closing near its high. They'd like it to look like 21 yesterday, or any bull bar closing near its high. And the bears are hoping the breakout below 5 will lead to a measured move down to the low of the day. Well, we did not close below 5 yet, so the bears are trying to get 9 to close below 5. They'd like 9 to close below 8, and then they hope for a measured move down, double top, neckline, and then a test of the low of the day. Consecutive bear bars closing below the moving average, and one of them closing near the low of the bar. That increases the chances we're going at least a little bit lower. Is it sell to close? And we're still probably always in long. So, and also it's a lot of limit order trading. So I think best choice here is flat. You could still be long, stop below 1. I think it's better to be flat and wait for the next buy signal bar, or wait for this to become more bearish and then sell. The reason 2-3 is as bullish as it is because it followed 1. The bears made a very strong move down, and it failed, and we reversed up. Can you argue that 1 is sell to close, and we have to test the close of bar 1? We may do that. I don't know that we'll get there. What about a Fibonacci 62%? I think not enough institutions pay attention to that for it to be important. Instead, I talk about 50% and a band around 50%. So a lot of times the pullback will be more than 50% or less than 50%, and I'll call it a 50% pullback. Like yesterday, 18 low, it's not quite a 50% pullback of that. I'd still call it a 50% pullback. 3 consecutive bear bars. So what happens if 10 is a bear bar closing near its low? That would be enough, I think, to make it sell to close. But I still think we're going to have a hard time falling below 1. So if you sell here, it's like buying above 2. You got to trade small, and you can add on if it keeps going down. And the bulls are hoping for a wedge, 3 bottoms, 5, 8, and 10, but they need a bull bar closing near its high. You always got to wait until a bar closes to make a decision about the bar. Right now, 10 looks like it might be what the bulls need. A bull bar closing near its high with a decent sized body. But let's see what the bar looks like when it closes. If it has a fairly big tail on top, you'll have fewer bulls willing to buy, especially after consecutive bear bars. If you're uncertain because of all the reversals that we've been having, you could wait for 2 bull bars. So instead of buying above 10, you could wait to see if 10 and 11 are both decent bull bars, and then buy above 11. Remember, if you're buying, you're hoping that this is the start of a big reversal up. And that means you're looking for it to rally for an hour or 2. And you increase your probability by waiting 1 more bar. So you might make 5 points less, but you'll have a higher probability of making money. So a lot of traders wait for a second bar. Okay, that's really not as good as the bulls want. So outside up, but close below the 9 high and close below the moving average. So yeah, it's a high 2, 5, but I think a lot of bulls are not going to buy above 10. Bears who are short for any reason, below 4, below 9, I'd get out above 10. You can always sell again if we get a bear bar 11 or 12. Most traders here, I think, should be flat. Everybody wants a trend, and we don't have one right now. Right now, we have a trading range. Every trading range has both a bull trend and a bear trend in it. For example, if we were to continue up here, we would say the bull trend began here. All right, so right now, we're in a bull trend. If we continue down, we'll say the bear trend began here. So right now, we're in a bear trend. And that's true of 100% of trading ranges. The market is always in both a bull trend and a bear trend. But the probability is greater that the market will keep reversing. Can you buy the 10 low because it's a bull bar and it's not a strong sell-off? Some bulls will do that. I think it's better to be trading with stops. Because it's a wedge bottom, 5, 8, 10, and we're breaking below it, there's a 50% chance at this point that the breakout will succeed and will go down for about a measured move, which would be on the 1 low or below the 1 low, and 50% chance the bear breakout 11 will fail and will reverse up on 12 or 13. Breakouts above or below wedges are common. And my general rule is 50% of the time they'll lead to a measured move. 50% of the time they'll fail, and the market will reverse again. The market will reverse again. Is it always in short at this point? Probably, if 11 closes down here. Back below the Globex low, back below the September low. Bears, where's their stop? Since this is a breakout below a wedge bull flag, the bears will be fairly quick to get out, maybe above 11. At the moment, I'm flat. I wanted to buy a high 1 or a high 2, but I wanted a bull bar closing near its high, and we did not get it. And I did not sell below 4 because we already had a bear trap 1 and then a bull trap 2, 3, and that increases the chances of a second leg up. And all the bulls got was 7, test of the close of 3. So you had some bulls who bought the close of 3, disappointed at 4. They bought more lower, 5, 10 points lower, and then they tried to get out around the close of 3. So they placed limit orders to sell at the close of 3, sometimes a tick or 2 below. And that's what happened. That's why 7 has that big tail. It tells you that a lot of the bulls who bought the close of 3, or above 1 or above 3, were sufficiently disappointed by 4 that they decided to get out around break even, maybe a small loss, and then look for the next buy signal. And 9 was the next buy signal, but not very good. We're getting near the end of the first hour. This is bar 11. Bears are hoping that the hour will close on its low, and the bulls are hoping that the hour has a bull body. The hour opened with the open of bar 1. So with all the trading range trading, I suspect we're going to close right around the open of the hour, which is right there. So the 60-minute chart right now is an outside bar, 60-minute bar, above the high of the prior hour, below the low of the prior hour. But with all the trading range trading here, I think there's a pretty good chance we're going to close the hour right around the open of the hour, that red line. So the bears selling below 10 right now are thinking, oh, no, they bought it. They bought the 10 low. They bought 5 points lower. All right. So that's not very good for the bears. This is bar 12. So, yeah, we're breaking below the wedge 10, but a big tail. So not very good to sell the close, and I would not sell below 11. And for the bulls, now it's a different way to look at it as a wedge. You can call it 8, 10, 11. You can call it 5, 8, 10, 11. A failed breakout below the wedge 10, but it's a bear bar. Remember I said that when you have a lot of trading range trading and the open of the hour is somewhere in the middle third, the market tends to close around the open of the hour. This is bar 12, so it's the end of the first 60-minute bar. Can you buy above 12 or above 11? The more 12 closes on its high, the more bulls will buy above 12. Some bulls will wait for 2 consecutive bull bars and then buy higher. If you're flat, that's a good choice. We're reversing every couple bars, and most traders should be swing trading, which means they're looking for the market to go 10 or 20 bars in one direction. And most traders should be entering with stops. And we have not had a good stop entry short since 4. And it would be hard to take that short and hard to hold short. And we have not had a good stop entry buy since 2 and 3. And it would be hard to hold long. Bulls trying to get 12 to close at or above the open of the hour. They're trying to get 12 to close at or above 11 and at or above the moving average. The more of those things the bulls get, the more bulls will buy above 12 and take a chance that this is going to be the low of the day. The less of that they get, the fewer bulls will take the buy. For the bears, are they selling with a limit order 11 high? They sold the 5 high, they sold the 9 high. Some bears are selling the 11 high, but I would not. They had a good attempt at a breakout below the 10 wedge, and now we're reversing up. So I would not sell. It's more likely now that we're going to try to go higher. Very difficult stop entry trading because your stops are too far. So, and we're getting a lot of reverses. The bulls who bought above 2 or bought above 1, above 2, above 3, and put a stop below 1, they're still long. The bears that sold below 4, I would not have done it, but if I did, I would be exiting around break even here on 12. Buying above 12, same problem as buying above 2. The stop is far below. You're risking 20 points, so you have to trade very small. Now you look at it and say, oh, it's disappointing. We're getting a tail, and if I buy above 12, I have to risk more than I want to risk. We're getting a lot of trading range behavior. I don't want to be buying too high up in the trading range. So good for limit order traders. You know, some traders sold with a limit order 11 high. They sold more 5 points higher. They can get out break even right now. They're hoping to get out with a profit. They're hoping it will dip back below the 11 high, allowing them to get out break even. Limit order traders have been rewarded all day, selling above everything, selling more higher, buying below everything, buying more lower. Anything that looks bearish, they buy the close of 4, 5, 8, 9, 11. And anything that looks bullish, they sell. They sell the close of 2, 3, 6, 10, 12. Okay? You can see we just dipped back below the high of 11. So the limit order bears who sold the 11 high and sold more 5 points higher were able to make 5 points. And for stop order bulls, that tail on the top of 12 reduces the number of bulls willing to buy above 12. Bears hope for a double top bear flag 10 and 12, but they need a good sell signal bar 13. They need a bear bar closing near its low with a decent sized body. Most traders should wait. We're getting too many reversals. So better to wait to get a reversal up from the bottom, but you don't want to be buying in the middle third of the trading range. Better to be buying in the bottom third, and better to be buying above a bull bar closing near its high, or look to sell on the upper third below a bear bar closing below its low, or wait for a strong breakout up or down. Strong breakout meaning a couple consecutive big bull bars closing near their highs, like 33, 34, or one really big bull bar like 19, and then buy the high 1, 21. And for the bears, you wait for a strong breakout to the downside. A pair of bear bars, 62, 63, or 63, 64. Breaking above 12, bulls trying to resume the bull trend that began with 2. And the bears are trying to get some kind of a double top 10 or double top 7. Probably back to always in long with that reversal on 12. If I have to choose long or short, I'd be long, but I think most traders are better off flat, waiting for more evidence that this is the start of a bull trend. 13, will it close on or near its high? That would be good for the bulls. Then we'll have consecutive bull bars closing above the moving average with decent sized bull bodies. That would increase the chances that we'll go higher. But stops are far away, both for the bulls and bears. So if you're trading with stops, better to trade small and better to be prepared to scale in. Bulls trying to break out above 12. A bull breakout is a bull bar preferably closing near its high and above the high of the prior bar. That's the minimum for a breakout. A bear breakout is a bear bar closing on or near its low, and closing below the low of the prior bar, preferably a big bear bar, preferably closing below the low of a lot of bars. 63 broke below 62, bear bar closing near its low, and 64 broke below the low of the prior 30 bars, 25 bars, since bar 26, so 40 bars. So the more bars it closes below, the stronger the breakout. So that's not really good buy the close, and for the bears, a double top, lower high double top 7, not very good sell below 13. So it's still slightly more bullish than the bearish, but most traders are better off waiting. Limit order bears sold 11 high, sold more 5 points higher, and they're able to scalp out. Limit order bulls will buy the 13 low, buy more 5 points lower, expecting to be able to scalp out. Most traders should just wait. This is all limit order scalping. Can you buy the market, bear bar, and a trading range open? I think most traders should just wait. Wait for a good bull bar near the bottom, a good bear bar near the top, and then take a stop entry trade. Most of the day, you're waiting. Even if you take a lot of trades every day, most of the day you're waiting, and that's okay. Most traders have a better chance of making a good living as a trader if they patiently wait for trends and then trade the trends. And right now, look at what we have. Reversing every few bars, every bar has tails. Does that look like this? Does it look like this? Does it look like this? Does it look like that? No. These are the kinds of things that you're looking for as a trader. Are we going to get a trend today? Probably. 90% of days, only 10% of days are trading range days in very tight ranges all day. So that means 90% chance we're going to get a trend, and it could be in either direction. Bulls want a bull bar, 15. A lot of times, 13, 14, 15 are kind of dead zone type bars. The market tends to try to begin a trend on bar 16 or later. I usually refer to bar 18. Yesterday we had an II, we tried to sell off. We had an outside down bar, we went below it. That was an attempt to go down, and then we had an even bigger outside bar on 19. So if the market doesn't make a move around bar 12, then you wait for 16, 17, 18, around there, 20, 16 to 20. Can you buy about 15 if it's a really good bull bar? If it's a really good bull bar, yes. But, I think you have to be pretty selective. Don't get too eager to take things that don't quite look good enough. You're looking for sustained selling, 2, 3, 4 bear bars closing near their lows, or sustained buying, 2, 3, 4 bull bars closing near their highs. And if you take a trade and you get a reversal within a bar or two, it's usually better to get out and then wait again for the next opportunity for a swing trade. Bulls hoping 15 reverses up and is a big bull bar closing near its high, and bears are hoping that 4 remains the high of the day and that we start to get a series of bear bars. Can you sell below 15 if 15 closes below 11? If 15 looks like 64, yes, but unless it's a huge bear bar, I would wait. Similar to 8, 9, consecutive bear bars closing below the moving average. And the second body, 15, is completely below the moving average. That's bearish, but the body of 15 is small relative to 14, and we still might be forming a higher low 11. So that's becoming increasingly bearish. You'll start to get some bears selling below 15, Others will wait to see what 16 looks like, hoping it's a third bear bar closing near its low. The bigger it is, the more it closes on its low, the more likely we've begun a swing down. And the bulls are hoping that they're hoping we've seen the low of the day, and that we'll form a double bottom with 11 or a double bottom with 1. Something bearish, consecutive bear bars closing near their lows, so bulls buy. Anything that's bearish, bulls buy. Anything that's bullish, bears sell. Trading range behavior. To buy with a stop above 16, the bulls will want more than a 1-point bull body. They'll want a bull bar that has a 2 or 3-point bull body. Otherwise, they'll wait. For the bulls, higher low 1, higher low 11, and now double bottom. And for the bears, we're getting lower highs. And whenever you have higher lows and lower highs, you're in a triangle. And where did the triangle begin? Did it begin with 70 or with 1? Some computers will say 70, others will say 1. Breakout mode. But having it be a triangle is really no different from having it be any other kind of trading range. It's still breakout mode. Outside up, forcing traders to buy higher and above a bigger bar, so a bigger risk. Can you buy on a stop above 15? No. Can you buy on a stop above 16? I think it's not exactly what I want. I did not want outside up. Outside up means 2 sideways bars, and we're right below the moving average. So I would wait for more bars before buying. And for the bears, I don't want to sell this low in a trading range. I want to see a strong breakout below the range, and then I'll look to sell. Like 64 yesterday, a strong breakout below a range. The bears who sold below 15, stop is above 13, but they'll get out before then. If 16 closes near its high, it's okay for the bears to get out above 16. We're in that window when the market often tries to begin a trend, but as I said, the outside up, I think, reduces the probability that this is the start of a bull trend. Bears, probably better to get out above 16. And for the bulls, everything is okay. This is okay, but I think most traders should wait. It's a tail, a close below 15 or below the moving average. Most traders are looking for a trend, and most traders are waiting. They're waiting for more evidence that a trend has begun. The bears hope 17 is a bear bar and that it's a low 1 after the 14-15 pair of bear bars. And the bulls are hoping that we reverse up strongly and break above the moving average. Most traders should wait for more information or for better looking setups. By the close of bar 18, 80% chance we've seen either the high or low of the day. It's slightly more likely that we've seen the low of the day. But we're in a triangle, and therefore it's not 60%, maybe 55% chance 1 is the low, and maybe 45% chance 4 is the high. And when I say high of the day, low of the day, today is a special day. We have the FOMC minutes at 11 o'clock. So I would view the day as ending at 11 o'clock and then a second day beginning at 11 o'clock. What takes place after the minutes has very little to do with what took place before the minutes. So I treat it like 2 separate days. Bull bar 16, they sold the high, sold more 5 points higher. apex of a triangle, the worst place to put a position on, so better to wait. When the market breaks out of a triangle and you're looking for a measured move, so if it breaks to the downside, measured move down. If it goes to the upside, measured move up. And then you're also looking for a reversal back to the triangle later on. We had a triangle here, we had a bear breakout, and then a reversal back up to the triangle. We've had a few triangles lately. I don't want to spend time looking for them. Slightly more bullish than bearish because we had a sell climax 1 and a strong reversal 2-3, and we're still above the bottom of the reversal low. We're still above the low of 1. Bears, another low 1. We have a bear breakout 14-15, pullback 18. Better to wait. Was hoping 18 is like 18 yesterday. A bear bar, we went below it, and then we went outside up. 18 today, bear bar, we went below it, and bulls trying to go outside up. They're hoping it'll be the start of a bull trend. If it is, it's probably not going to be as bullish as yesterday. Much more trading range trading today. Limit order bulls, bought 18 close, bought 18 low. Stop order bulls, will they buy above 19? A lot of trend traders, stop order traders, will wait for more evidence of a trend. So they'll wait for 2 or 3 bull bars or 2 or 3 consecutive bear bars. Very often the market will do something similar today to what it did yesterday at the same bar. So yesterday we had a bear bar on 18. Today we have a bear bar on 18. And then yesterday we were outside up on 19. And today we're outside up on 19. Can you buy and take a chance for the stop below 19? The probability is not very good. So if you're taking it, you're looking for a big reward and good risk reward to offset the low probability. But if you're holding for a big reward, that means 10 or 20 bars. Why not wait another bar or two to see if you have a higher probability of success? A triangle is a breakout mode pattern. And whenever there's a breakout, always assume 50% chance that it'll be successful and lead to a measured move, and 50% chance it'll fail and reverse. Outside up, always in long, still on the buy above 16, but tail, and still in the apex of a triangle. Bulls, I'd get out below 19, and the bears need 20 to be a pretty good bear bar to sell below 20. Most traders are better off waiting. Still not yet clear enough. I keep saying slightly more bullish than bearish, and I mean slightly. We would not be going sideways in a triangle if it was clearly bullish. It's not clearly bullish. It's slightly more bullish than bearish. I said the bulls are bought above 1, 2, or 3 could hold long with a stop below 1. At this point, if those bulls are still long, I would get out below 11. We have a double bottom, and if the bulls are in control, they should be able to continue up here. And it does not, to me, it looks slightly better than not, but not very high probability. So the stop for traders using a wide stop now, I'd get out below 11. A swing trader could be long or short here. They could be long a stop below 11, betting will go up for more than a measured move. they could be short, stop above 13 or 7. Betting will break below and fall for more than a measured move. Well, I think both of those are barely profitable strategies. If you do that 10 times, you'll make money, but not a lot of money. I think it's better to wait for the breakout or for a better buy or sell setup. Bulls breaking above the triangle. They're hoping to get bull bars closing on their highs and bull bars closing above the high of the prior bar, like 21 closing on its high and above 20. That would increase the chances that we're going higher. So becoming increasingly bullish. And the bears need a pretty strong reversal down. Bears want a good sell signal bar for a failed breakout, but does not look like it's going to be big enough for bears to sell below 21. And the bulls, obviously, we're hoping for a very big bull bar closing far above the triangle. Instead, they have a small bull bar. So it's still slightly more bullish than bearish, but not all that bullish. Can you buy the market and exit below 21? If this is going to trend up, it should not go below 21. So the math is okay, but higher probability to wait to see if we surge up and get a big bull bar. It's okay to buy the close here, but it's not yet high probability. If the bull breakout, if this is the start of a bull trend, this should not immediately pull back below a bull bar, closing near its high, 21. I did not buy, but I think it's okay to buy. And for the bears to short, they need a pretty good bear bar. Even though the bull bars are small, they're important. They increase the chances that we've begun a swing up. Sometimes it's reasonable to buy small, and if it keeps going up, you add to it as it goes up. Bears want double top 13. Bulls, for the first time today, have 4 consecutive bull bars. Not very big, but still good for the bulls. For the bears, double top 13. Can you get short below 22? A failed breakout? I would not. I'd wait to see if we get a bear bar. Bears double top 13, but nobody wants to sell it. You can see they bought they bought the 22 low. And the bulls right now stop below 19. With this outside up, they'll probably get out below 23. They're hoping that this is the start of a swing up. I did buy above 21. I bought more 22 low, but I'll be pretty quick to get out if this does not continue up. Remember, even though we broke above a triangle, we're still at the top of a trading range. So there's still a number of bears looking to short up here. Bulls want bull bars. They don't want to see bear bars at the top of a trading range. So they'll want 23 to have a bull body. Not behaving well. We went outside up, and now we're going back outside down. Okay, so I got out and back to flat. Can I sell below 23? I'm not going to. Bears double top 13, a low to 18, but right now it's a small pullback bull trend. Bad bar for the bulls. bulls who are still long, I'd get out below 23. And for the bears, I think it's not yet good enough to sell. I would get out of longs here below 23. You can always buy again if 24 is a bull bar. And for the bears, I think a tight bull channel, probably a minor reversal. I want to say something about Cathie Wood. This is her ARC Innovation Fund and 5-minute chart. And I do day trade it pretty regularly. The volume is huge, 100,000 contracts per 5-minute bar. And I'm bringing up Cathie Wood because of this. Here's the weekly chart. And her fund, this is an ETF, the ARC Fund, ARC Innovation. What she does is she buys a bunch of garbage companies and takes a chance that they'll go up much more than the market. And she calls the companies innovators and disruptors, and she believes they're going to, at least some of them, will become the next Amazon or Microsoft. But I think of them as garbage, and most of them will go away. Snap, Snapchat, and there are a whole bunch. Teladoc, she's got a whole bunch of garbage stocks in her fund. And I'm bringing her up because of this. In 2020, her ETF was the best performing ETF in the United States. It was up 70% on the year. And she got a lot of publicity. She was on television all the time being interviewed, and people were always asking her opinion. Oh my gosh, she's up 70%. She must be brilliant. And, that happens. I've seen that happen a lot over the past 35 years. Somebody does something spectacular, and they get put on TV all the time as if they're a brilliant person, and everything they say is going to be right. And that's nonsense. One of the clowns from The Big Short, they put him on television pretty regularly. Wolf on Wall Street, they put him on television pretty regularly. And Cathie Woods, they put her on pretty regularly because of this. But most of her career, she's been very ordinary at best, from what I can see. And she had a good year. And just because she's on television and just because her fund was up 70% does not mean she is any better than any other Wall Street person. And look at this. She's lost 70%. We're back to where her big rally began. This is the weekly chart of her fund. So just because she's on TV and they talk about how her fund went up 70% in 1 year, it was the best performing ETF on Wall Street, that does not make her any better than anybody else. And you can see the market has totally undone all the good that she has, that she did. There's a lot of people resent her publicity, and one guy or one company created an inverse ETF, a short version of her fund. So anything she buys, they sell. And here's her. This is the inverse fund. It started a couple of years ago, and you can see it's up a lot. It's doubled since it went up. And that makes sense. If ARC is going down big, a fund that's shorting everything in ARC should be up big. That's just it's entertaining, that someone would create an ETF that's exactly the opposite of someone else's ETF. And it's just a pure sign of incredible disdain, disrespect. But my point is, when you see experts on television and they're acclaimed as brilliant prognosticators because they made a prediction that turned out to be right, they're no better than anybody else. And a lot of them are just idiots who take low probability bets. And, a broken clock is right twice a day, right? So even an idiot is going to be right occasionally. Another example of that was back in the 80s, Robert Prechter, who popularized Elliott Wave. always was predicting crashes. And then the market finally crashed in 1987. And there was a report that I think he sold, I don't know, I forgot what it was. Everybody started subscribing to his newsletter. I subscribed to his newsletter in 87. And I forgot what it was, like 100,000, he had 100,000 subscriptions after the crash. And it was like $300 or $400 each. Anyway, he made, my calculations at the time, he made about $30 million because of that prediction. And he kept predicting crashes afterwards. And I'll put up, well, I'll do this. Here's a monthly chart of the stock market. So here's the 87 crash. And he was right. And he kept predicting crashes. And this is what the market has done with all of those predictions. You know, obviously horribly wrong, right? So again, another example of somebody being right once does not mean they're going to be right consistently. And just because you see an expert on television and the television people build them up as a guru or a wizard or, you know, some great expert, don't believe it. You know, there are lots of other people who believe the exact opposite. You should always assume that the market is in balance. If it's going up, it's in balance. If it's going down, it's in balance. When it goes down sharply or up sharply, there's a slight tilt, you know. So when it's going up sharply, it's slightly more bullish, but not much. When it goes down sharply, it's slightly more bearish, but not much. And if you looked at options during the sell-off, and you looked at money put options, you think, oh my gosh, it's falling dramatically. The out of the money puts have to be skyrocketing. Well, guess what? The puts might be a little bit more expensive than the at the money calls, but not much. And that's because the institutions think that the market is in balance. It might go down a little bit, but they're expecting that whatever option expires, it'll be right around the current price. So, you know, the market has a lot of sharp moves up and down, but that does not necessarily mean that the market is in the early stages of some huge move. You know, the market at any instant is balanced between the bulls and bears, and occasionally it's slightly more bearish or slightly more bullish, but I always use slightly. You know, on any time frame, always assume that 95% of the bars are pretty much neutral. And by that, what I mean is 60%, no more than 60% chance the market will go up X points or X ticks before it goes down X points or X ticks. So the probability of a move, you know, 10 point stall, 5 point stall, being up versus down, the probability is between 40 and 60%, 90% of the time, 95% of the time, 5% of the time. It could be 70% that we're going to go lower. And that X, the size of X, it has to be within the size of the bars on the chart. So if the bars on the chart are 10 points tall, you know, and you want X to be 500, it doesn't make sense. You know, but if you're using X to be, you know, about the size of the bars on the chart, you know, and the bars are 10 points tall, 20 points tall, 50-50 chance. Well, here it's closer to 60 or 70% chance we're going down 10 points before it goes up 10 points. But throughout here, it's between 40 and 60% chance the next 10 points will be up versus down. So for 95% of the bars on the chart, you should always think of the probability of anything as between 40 and 60%. And only 5% of the bars on the chart is the probability 70%. 70% that it will go down 10 points before up 10 points, down 15 points before up 15 points. Now, can you redraw this and say it's a bigger triangle? You know, it's not a triangle now, but it's still a trading range. So we're still in breakout mode. slightly higher high double top here. So we're still getting slightly higher highs and slightly higher lows. Bulls need a good bull bar, and for the bears, it's not yet a good short. You can argue we're still short below 4, and that's true. Some bears are short below 4, stop above 4, and they're just going to hold all day and either get stopped out or they'll make a lot of money on the downside breakout. And the opposite is true of the bulls. Some bulls are long, above 1, above 2, above 3. Now I would have my stop below the double bottom, 11.16. And they just hold, waiting and hoping that they're bought the low of the day. Right now, more than 80% chance we've seen either the low or high of the day. And again, because it's an FOMC day, when I say the day, I mean until 11 o'clock. You should assume the day ends at 11 and that a new day begins at 11. You can see it's still limit order trading. Traders buying below bars, buy more 5 points lower, scalp. Sell above bars, sell more 5 points higher, scalp. So best choice here is flat and wait for either a strong breakout up or down, or wait for a good sell signal bar near the top or a good buy signal bar near the bottom. Still reversing every few bars. Down on 24, up on 24. Down on 25, up on 25. So micro double bottom. Up on 24, up on 26, micro double top. So breakout mode, but I think it's better to wait. What happens if we get a bull inside bar 27 closing on its high? No, we're just right above 26, so that's not going to happen. But what I was going to say is it's still better to wait. The most recent reasonable stop entry signal was buying above 16 or 17. So theoretically, we're still on that. And right now, I would, if you're long, I would get out below 25. Bulls again, trying to get to the upside breakout. And you sell the market and bet on a failed breakout. The math is probably okay, but I still think we're slightly more bullish than bearish. The bulls are hoping 25 is a pullback after breaking above the triangle, and they're hoping 27 is a resumption of the bull trend. Bulls looking for bullish things. So they want bull bars. They want consecutive bull bars. They want big bull bars. They want consecutive big bull bars closing on their highs. The more of that they get, the more traders will be willing to buy the close and buy above the high of the prior bar. The less of that they get, the more traders will be willing to sell closes and sell above prior highs. Right now, you have bears selling the 23 high, betting the breakout will fail. Bears will sell the 27 close, but they'll be quick to get out. And bulls, if 27 closes at or above 23, you'll get more by the close bulls willing to take a chance. But a lot of the bulls will wait for consecutive closes above 23 and consecutive bull bars closing near their highs. The absolute minimum, close at the 26 high instead of above 23 and instead of on the high of the bar. So that's not going to attract a lot of buy the close bulls. Still slightly more bullish. We're above the moving average. The most recent stop entry setup was a buy 16, but the bulls are not doing what they need to do to make a lot of traders willing to add on to positions as it goes up. Better for most traders to wait. You can always buy small at the market and put a stop below 25, but I think it's still better to wait. And for the bears, can you sell the market betting on a failed breakout? You can call it a wedge. 23 is slightly above 13, so you can call it a wedge. 13, 23, 27. You can call it a failed breakout of a double top. which is 3 pushes up, and it's a variation of a wedge, but I think better to wait. Anytime the market tries to do something several times and fails, you got to be thinking it might do the opposite. And there are a whole bunch of 3-push patterns, and I think they're all basically variations of a wedge. The market's trying to do something 3 times. So triple tops, it tries to go up 3 times, fails. A head and shoulders top, it's 3 pushes up. The 3rd push did not go above the 2nd. A double top pullback, you got 2 pushes up. A 3rd push formed a lower high. You got a double top and a breakout, failed breakout, another double top and a breakout. You have a wedge top. You have a triangle. It's all examples. They're all variations of triple tops, I think. And market's trying to do something 3 times and failing. It then often tries to do the opposite. So it's the same forces at work in all of these things. And the opposite's true for wedge bottoms and triple bottoms. They're all variations of the same thing. Sometimes you get a perfect triple bottom, but a lot of times the 3rd low will be slightly higher. You have a double bottom pullback, and a lot of times the 3rd low will be lower. You'll have a failed breakout below a double bottom, or you'll have a wedge bottom, or you'll have a triangle, higher lows. And here you get a head and shoulders bottom. The 3rd low did not go below the 2nd, but all examples of variations of a triple bottom. 3 pushes down, and the bears gave up, and the market went the other way. For the bulls, a bull breakout 27, pullback 28, so it's a high 1, but a bear bar and tail 27, I think not a very good buy above 28. And for the bears, a triple top, a failed breakout above a double top, 13, 23, but tail just above the moving average. So not a good stop entry sell below 28, not a good stop entry buy above 28. Best choice flat, 2nd best choice long since the buy of 16, exit below 25. And 3rd choice, you could still be short below 4, but I think that's the lowest probability of the 3 alternatives. Most traders should just wait. Slightly more bullish, we're holding above the moving average, and the most recent stop entry signal was 16, a buy. Bulls trying again to get their breakout. And bears, limit order bears, they're selling the 28 high, selling more higher. You know, the probability is slightly better for the bulls, maybe 55% chance the bulls will get their breakout, 45% chance the bears will get their reversal. But until there's a breakout, there is no breakout. And that means there is still a significant chance we'll reverse. So that's why I'm saying 45% chance this is a failed breakout to the upside and that we will reverse down. If we go above 27, are we going to accelerate up? Or will there be sellers above, like above 13 and like above 23? As I said, slightly more bullish than bearish. So it's slightly more likely that we'll go up. Not good math, all right? I think we're always in long. I think a person could buy for any reason, stop below 25, but I think it's higher probability to wait for more clarity. You know, that's risking 10 points. And how much do you stand to gain? If we do go up, you know, the next resistance is about 15 points up. So you're risking 10 points to make 15 points. And the probability is only slightly better than 50-50. So that is not really strong math. If you buy above 27, you hope that it races up. And if it does not race up, you quickly get out. That's the breakout. The bears want a wedge, 23, 27, and the bulls want a successful breakout. And so far, it's not doing what the bulls want. You can see a lot of bulls are dumping right here. They wanted it to go 2, 3, 4, 5, 6 ticks above 27. Instead, it went just a little bit above and immediately reversed down. For a sell signal here, the bears want 30 to be a bear bar closing near its low. You can call it a wedge, 23, 27. And to sell below 30, the bears will want 30 to close on or near its low. Perfect doji, that's the absolute minimum that the bulls want. So it's still slightly more bullish than bearish. Can you get out below 30? That's a fairly tight stop, but if this is the start of a swing up, I think the market will try to stay above the high, to stay above the low of the prior bar. Can you sell below 30, a wedge, 23, 27? I would not. So I'd either be long or flat, and I think flat is the better choice right now. And to go short, the bears need a reasonable sell signal bar. Remember, get flat before the FOMC meeting at 11 o'clock. And when the meeting, when you get the announcement, expect a move up and down, and one of the two moves to be the correct direction. 15% chance you'll get a bear trend. Wait for at least a couple bars before selling. 15% chance you're going to get a small bull trend. Wait at least 2 bars before buying. 15% chance you'll get a bull trend that reverses. Here we got a micro double top, a bear bar closing near its low. 15% chance you'll get a sell-off that reverses up. Here we got 2 legs down, 1 pullback 2, and here we have a higher low double bottom. So you could start buying. 15% chance you're going to get a lot of reversals. Reasonable buy, but at some point you have to decide this is a trap and that we're going to reverse down. So wait for 2 or 3 bear bars if it's not clear, and then short. And 10% chance the market makes no significant move on the FOMC announcement. So here, the bulls are hoping the bull trend from 16 will continue, but right now it's not yet strong. It's slightly more likely that we're going to go up, so it's okay to be long, but it's really not all that bullish, and I think most traders are better off waiting. Okay, I'm going to sign off now.